going to get started. Again, welcome to the Cascade Compliance recap of the 28th Annual GIPS Standards Conference. My name is Kim Cash, and I'm joined by my partner, Janice Kitzman. We were both in attendance at the conference, actively listening for all the current updates and interpretation reversals and otherwise solid content that needed to make it into our 1-hour overview of 2 full days of excellent investment performance education. We couldn't include everything, but we have a full hour ready for you. No need to feel rushed. We're touching on 6 big conversations rather than session by session, and we hope that there's plenty of time for Q&A at the end. You can also always reach out to either of us with any follow-up questions. We're going to start the day with key GIPS standards updates, and then SEC updates, tips for robust policies and procedures, deep dive into performance and attribution, conversations on artificial intelligence, and then end the same way the conference ended with Help Desk Live Q&A. So let's get started. GIPS standards update with an overview and a, oh my goodness, we're not moving through, are we?
Yeah, we are not moving.
I just realized I'm
okay.
moving through, but they're not. So I apologize. Let me figure out here how to be right here. Yeah, there we are. Okay, this is our agenda, and here we are with the GIPS standards update.
Also, yes, the slides will be distributed to the attendees after the webinar, probably early next week. And then please feel free to use the chat function or Q&A function for any questions during your presentation. We don't mind stopping and answering any of your pressing questions.
Thanks for that, Janice.
Absolutely.
Yeah, no problem.
Make this a dialogue. There are now 41 country sponsors with more than 1,700 firms claiming compliance in 51 markets globally. Every year, CFA Institute puts up how many of the 25 largest global asset management firms comply, and this year was the first year all 25 of the 25 comply. So the marketing rule is not replacing the GIPS standards, but rather making composite performance even more relevant for regulatory compliance. So that was an exciting development. Karen Vincent, head of the global standards at CFA Institute, slipped in a trademark lesson that was really well done. We have to get nitpicky with our clients all the time on how the word GIPS is used in their presentation materials. And we also have to be vigilant in how we are pairing GIPS as an adjective, not a noun, with which friend words in our written communications. Not a problem if you just say GIPS verbally. Anyway, it was a really well done session, but nothing particularly new there. There was new Q&A in June of 2024 for firms who use custom portfolio weighted benchmarks. And so I have that bolded because that is a reversal in what used to be required was that you actually included all of the weights of all of the different benchmarks, which for a composite with clients all having different benchmarks, this could be a page of disclosure in and of itself, just showing the current weights of a custom portfolio weighted benchmark. And so what the new Q&A allows is for you to aggregate the benchmark components by however you think is most meaningful, and that might be by country benchmarks, by country it might be by sector, and then just disclose the component percentages of the benchmarks for the current year end and make available both the current year end and the underlying benchmarks for both the current year end as well as any historical periods, because every year if you're custom weighting with what the portfolio has, it's going to be a little bit different. So you make those available upon request, and there could be pages and pages of historical benchmark returns weights. But on your performance presentation now, you can aggregate by component. So that was a big change for the firms that use custom portfolio weighted benchmarks. There's also some proposed guidance upcoming that was introduced and discussed GIPS more exciting for verifiers. A handbook for verifiers is in a work in progress, and the GIPS verifiers for asset owners is soon to be out for public comment. An attribution white paper is also in a work in progress, or at least being floated right now, as well as an inquiry during the conference again this year about after-tax guidance, with the audience overwhelmingly saying, yes, we would like to have that. And so that might be back on the table. Other resources that are new for folks, if you go to the GIPS website, they have so many wonderful resources, and that's continually updated. They conducted a marketing role survey. They also had some webinars with Annual GIPS on the private fund rule, which, even though that is no longer active as it was repeated during the conference, it is a great examination blueprint for what the SEC considers important for fair and balanced performance. And so you could look at that like a very long risk alert and don't necessarily want to toss it out. Janice, how about the 2 guidance statements?
Yeah,
again,
so there's...
I'm not... Here you
That's
go.
okay. So there's 2 new guidance statements, one which has already been issued, and that's the broad distribution pooled fund guidance statement. That's effective July 1st, 2024. It applies only to firms that manage broad distribution pooled funds, and kind of switching them because this one is already issued and it's already effective. And so if you are a firm that manages only broad distribution pooled funds, this guidance statement may apply to you. The reason why it may not apply to you is if you are wanting to get separately managed accounts and putting broad distribution pooled funds in composites, then you'll need to look at the guidance statement and determine if it's the right fit for your firm. The OCIO guidance statement, this has been, it's been a labor of love for most of the people working on this. It's been in the works for a long time, and it's projected to release in November of 2024 this year. It hasn't changed a whole lot. There is some change on the ranges of, liability-driven investments, growth versus all the asset allocations. So there are some minor changes, but for the most part, it's been largely adopted as is, and it'll apply to firms managing OCIOs portfolios, and that really comes down to you have to provide investment advice as well as strategic asset allocation. And there will be an OCIO composite structure, which this is the first time that the GIPS standards has ever required a structure for composite creation. It doesn't mean that you can't have things outside of that, but there is a minimum standard now in this guidance statement. And then also, it's the first time that they've required both gross and net returns to be presented. I think a big thing to know is the OCIO guidance statement was created out of an OCIO working group. And so CFA Institute, what they did is they gathered a lot of professionals that manage OCIO portfolios or are at OCIO firms and got their thoughts. And these are essentially, this guidance statement is what everyone could minimally agree on and decided this is something that the industry needs. There's a lack of standard reporting, and this will help get the industry to a consistent place, which those of you who manage equity fixed income, this is what we went through 25, 30 years ago. So it's similar to that, and now it's come to the OCIO segment of the industry. And so with that, Kim's going to talk about the SEC update section, which is pretty big. There was a lot of conversation around SEC updates.
Yeah, and there were actually 3 different sessions. 2, we had Division of Investment Management and Division of Examinations, which is where we're going to start. And then we also had a panel that focused on the private fund rule. So 3 sessions really covering SEC overlap with investment performance best practice. So we're going to start with the Division of Examinations. It was really just a current state of the SEC. 15,000 firms, more than 15,000 registered investment advisors, and 14,000 funds, and they're managing more than 13 trillion in assets, and there are about 615 examiners that are in charge of this division. So it is a very large division. Roughly 3,000 registered investment advisor firms are examined each year by the 10 offices across the country. Used to be 11, they closed Fort Worth, and they started this session with a poll, who's been examined, and almost half the people in the room had been examined within the last 2 to 5 years. So that is actually a lot better than I think where they were 10 years ago. So just some nice best practices and information from an examiner's perspective. Our two practical takeaways here are based on the two deficiencies that he discussed, being the number one deficiency, inadequate or not implemented policies and procedures. So you want to make sure you have robust policies and make sure they're implemented. And then the second most common deficiency was errors in the ADV. And of course, it's changed. It's a long, detailed disclosure. So it is easy to have errors and really important to keep it up to date with what your firm's actually doing, the strategies, the fees, the team, and make sure it's accurate. Other items that got discussed in this session, very high level, nothing particularly new. Definitely wanted to emphasize that the Division of Examinations is using independent judgment, that enforcement has their own priorities. The Division of Examination publishes their priorities every year, and verification, whether you're verified or not, is not going to change the SEC's testing. Specific to the marketing rule, he did kind of point toward the most recent risk alerts for areas where there are the most failures around use of third-party marketers and testimonials, and making sure you have proper policies and disclosures, and as far as performance advertising, not advertising hypothetical performance on the web. I think we all know that. Because artificial intelligence was talked about a lot during this conference, someone attending did ask, how does the SEC use artificial intelligence, in exams and social media postings? But the examiner was not willing to comment on that one. So, moving along to the SEC marketing rule update, which on the panel included someone from the Division of Investment Management. Lots of good information, and I bolded here a couple areas that I feel like are really new, either more in-depth or reversals. So, first and foremost, when you're talking about the SEC marketing rule, be mindful of the general prohibitions as much as just the technical details. So you need to be fair and balanced, and that includes being complete. You can't comply technically, but leave things out, you're not going to be compliant then. So that's really important to keep in mind whenever you're talking about technical areas. There was some discussion around benchmarks and differences between the SEC marketing rule requirements and the GIPS standards. The SEC doesn't require a benchmark, but if you don't have one, you're going to have a full page of disclosure around market conditions over the performance period you're showing. And that is to prevent a manager who has an equity portfolio that performs 15% when the market did 30% over the same time period. That 15% may look good by itself, but when you see compared to what the market was doing, you know what, there would need to be a lot of disclosure around why that happened so that a prospective client could make a good decision there. Better just to show a benchmark. For everyone on this call, presumably most of you are already GIPS compliant or thinking about it. The GIPS standards require benchmarks. You have to show them unless there is not an appropriate benchmark available, and cost is not a basis for saying that it's not appropriate. There was a great question when we were talking about benchmarks, about target benchmarks. And, first of all, are benchmarks hypothetical? No, they're not. If you're showing historical performance, yeah, they're not investable, but it's really, it's a constructed historical comparison of what's happening in the market. So it is good to define them and define any differences between your strategies. Benchmarks are not hypothetical historically. Now, they could be hypothetical if you have a projected return of maybe a benchmark plus X for your strategy, and it's really a facts and circumstances basis. So the use of benchmarks, they're not hypothetical. You don't need disclosures around that unless you're, and it depends on how you're using them. And if you're saying, this is what I would have done for you, even historically, you have to be careful when you pick a specific fund or a specific stock as a benchmark, or a deal as a benchmark. This is what I would have done for you if it wasn't what you were actually invested in, is very different than saying, and here are the characteristics of what we are currently recommending. So it could be the same fund, you're showing it, but in a very different context. So that's why, you know, general prohibitions really matter to think about, is this fair and balanced? Okay, extracted portfolios. So gosh, for 3 years, I feel like we've been talking about this difference where the SEC said, man, if you have one account extraction, one portfolio, then you can show that equity performance and it's not hypothetical. But if you have more than one, it's hypothetical. And this has created a lot of discussion. And where we went this year at the conference was where I think a lot of our clients have landed. And so it was great to hear it discussed with an SEC examiner on the panel, even though it was just his opinion. And that is that it really comes down to, is this sub-portfolio of equity returns in a balanced composite, is it really a strategy? Are you reporting it to a client on their client reports as a separate number? Are you, along with fixed, along with balanced, or other components of a multi-asset portfolio? Does it have its own cash? Does it have a separate management team maybe than your fixed income? There's lots of considerations that could really bolster how this is really not cherry picking. This is actually a meaningful sub-portfolio, not an extract. And so being very intentional about your documentation could really lend itself to being able to show extracted performance of a composite as a sub-portfolio, especially, and they defined portfolio in a way that, you know, it could be a composite, could be an aggregated portfolio. So it could still be a single portfolio. And so really recommending that if this is important to you and how you show your performance to current clients, prospective clients, then you could do some work here and really be able to demonstrate that. And am I on the right one? Yeah, I am. Good. Sorry, I have two screens going, and that was throwing me. But you could really be able to demonstrate to a field examiner at least that you were acting in good faith, even if your ultimate interpretation ends up being different. So I think there's a little more room for spectrum of risk here, which was another phrase that was really important when it comes to making some of these decisions. Another area that was new from guidance that was provided, and I'm going to go ahead and change this now. 2 years ago, on the same panel with a different SEC examiner who's been very involved in writing the rules, we talked about what about multiple return streams on the GIPS report or on a performance report. And the thinking then was that, you know, performance can so easily mislead. We don't want to risk misleading people, so really discouraged having more than one net return. And then this year put up a table with a column of net returns. And what's really important to notice here is that, and they also included actual, all of the model returns are lower than the actual fees. And so that is really important. We get the question all the time with fee compression, can't we put up something that is something that actually demonstrates what we're offering to our clients now? And they didn't answer that question. I said, what if it's lower? I would love to hear their answer. We have our own answer. And then this question did come up in two other sessions, one that took a very conservative approach, which is no, SEC and GIPS neither let you show a model return that is better than the actual, period. And then another guest speaker offered the perspective that you could show a supplemental net of fee model with the fee you're actually offering, and as long as it was labeled supplemental, that you could do that. We're not recommending that.
I was just about to ask that, Kim.
Okay, so 1 minute of explanation why we're not recommending that, even though that's certainly a situation that most firms find themselves in with fee compression. So I think for GIPS purposes, one of the problems is supplemental information isn't supposed to contradict required information. And so a composite model return history better than the actually achieved performance could be a contradiction. So it wouldn't qualify as supplemental. And then for SEC purposes, so even if you showed it off the GIPS report somewhere else, because a model composite return that hasn't actually been achieved, that's actually better performance than was ever actually achieved, that sounds like their definition of hypothetical. And so then that would have all kinds of other restrictions in terms of documentation and who you show it to and when. So, in thinking about this and turning over what that panelist had brought up, I thought, you could actually label as supplemental here the actual net returns of a representative account, because that performance would actually be achieved. And if they were being offered the same fee that you're offering your prospect, then that could be meaningful. And so then you have to, have some decisions around which is their gross performance still the same as the composite whenever you pick a representative account. So lots to think about here. The real takeaway from all of this on this table is you can show multiple return streams, net of different models, and if you're combining some institutional and high net worth accounts with possibly some wrap accounts that have had estimated transactions coming out, and they're all in that gross return, it might be nice for you not to have 3 different presentations and be able to show one GIPS report that includes the different model fees that are appropriate to each of those. So that is, I think, the real takeaway. And in terms of your sales team that gets caught up in, but the fees we're offering are lower than the actual fees of the composite because of fee compression. Janice and I both tell people, you know what, that's okay. They can show them the most relevant column, and if that's actual, great, and you can tell them, and you're paying a lower fee than clients paid historically, so your returns would have been even better. And with that, Janice, I'm going to turn it over to you to share some more fee information.
Yeah, so just real quick, this will be a quick overview. One of the things that I heard at the conference, Kim and I do this all the time, right? We're looking at GIPS reports and marketing materials. But one of the things I heard pretty consistently at the conference from attendees and our clients was it's so nice to still be talking about this and have the repetitive nature of it because it's sinking in. And I think, when we talk about performance returns and net returns specifically for composites, it was real interesting. There was a question or a statement made during the conference, during one of the sessions, about if you're showing net returns, really rethink that. If you're showing net of actual returns, really rethink what you're doing and why you're doing it, because the industry is headed towards net of model fees. And I thought that was interesting because it was Karen Vincent who said it. And while actual fees can be used, they need to be representative. And in our experience, most of the time when actual net of return fees are being used at a composite level, they're not really representative of what a prospective client could receive. And so that's something that you really need to weigh, and it goes back to that spectrum of risk, and making sure that you're okay taking on additional risk as it pertains to whether or not you're presenting actual net of fee returns or model fee returns. Also, making sure that your performance reflects the deduction of fees and expenses. The GIPS standards only require net returns to reflect the management fees and transaction costs and performance fees, of course. But in talking with SEC, just reevaluating your fees and expenses and making sure that, again, it goes back to the management of the portfolio and making sure that the net returns reflect all of the deduction of fees that go into the management of the portfolio. And then, of course, gross returns, you need to show with net returns. We know that, but putting your gross returns at the front of the presentation, your net returns at the back of the presentation doesn't qualify as equal prominence. So continuing to make sure that you're reviewing your pitch decks and your fact sheets for those types of things, and then disclosing what is deducted from the gross returns. If there's transaction costs, which there should if you're GIPS compliant, and then any admin or custodian fees that might be deducted from the gross returns.
Yeah,
so,
and we're talking a lot about this, but I think you're absolutely right, Janice, and they focus on this a lot. With funds, those admin fees typically come out of both gross and net, even though we're really talking about composites, we don't usually see admin fees coming out. And so what they showed at the conference was some examples of maybe an icky fund advisor who was kind of grossing up by admin fees because as if he didn't have to take them out, but they weren't really GIPS compliant anyway, because for funds, they have different rules. Is that, right. More on that? Yeah. Yeah,
I think that's our next slide that we're going to talk about is the private funds. So for the private fund Q&A, there's been 2 Q&As related to private funds over the course of the marketing rule since the release date. There was one in January 2023 talking about single deal level returns must be net, and then in February of this year, there was a Q&A related to returns and subscription lines of credit. One of the things that was, I think, really well stated and good to know is the SEC is not interested in governing this marketing rule through Q&As. And what they do with the Q&As is to provide clarification to the existing rule. They're not looking to put out new rules based on the Q&As, and they actually said that's not what they're doing. They believe that the Q&As that they have put out are just clarifications, and Kim and I both agree with that. We do think that they are clarifications, and the Q&As have been helpful, I think, in helping firms avoid some deficiencies and making sure that they've got what they need to have, especially as it pertains to the deal level return being net and the subscription lines of credit, gross and net, having the same data and the same return stream. Kim, do you have anything to add to that?
No, I agree.
Yeah, and lastly, if net is better than gross, it's probably misleading. So make sure, that's a really great check. And I think in the private fund world, that can happen sometimes with clawbacks and those types of complicated fee structures. So making sure that you're watching that.
Yeah, that's a good check.
Yeah.
And I think in the Q&A from February, really dealing with subscription lines of credit and different dates. And an example they showed, it is very easy when you have truncated periods to, if you're showing net with with one assumption and gross with the other, it's very easy that your net performance actually does look better. So I think that's a good check on whether it's material or not.
Yeah.
Okay. Private fund rule, Janice, more funds for you.
Yeah. So when the private fund rule came out, the CFA Institute created the private fund working group. Now, we all know the private fund rule has been vacated. It is no more. However, it's still a good blueprint, and I think the SEC is continuing to look at that as a framework for how funds need to be reporting and what they need to be doing on the calculation front. So it's something to really still consider. We actually wrote an article in NSCP Currents this month regarding private funds and the calculation methodology. There's some, there's a lot of different ways, and this is what the private fund rule exposed, and what the working group exposed is that there is a large diversity of practices going on in how private funds are calculating their returns and what they're reporting to clients. So even though the rule was vacated, it has still opened up a lot of opportunity for there to be synergy between really the CFA Institute and then ILPA. So ILPA, they've been working on quarterly reporting standards. They have an initiative going. What's been really interesting is watching ILPA kind of work with CFA Institute and work with the private funds working group to get some consensus on what is going to be required with ILPA and what may be recommended. So I think that there's some really good takeaways on what is upcoming, especially for firms looking at ILPA altogether. There's some clear guidance on reporting with and without the subscription, making sure that you're showing consistency across the board with gross and net performance, using NAV-based facilities. What does that look like? And then really just leading with standardization, not new requirements. I think that's a really important point because there hasn't been a lot of consistency on what's required until really now. And I know that CFA Institute wants to work within the framework that has been put out there by PFAR, as well as what ILPA is doing, so that firms don't feel like they have to comply with 3 different things. That's been really important because we all know that compliance it can be challenging, and it gets more challenging the more standards you have to work with. So that's something else that I think is really good that's come out of the private funds advisor rule.
Yeah, and this particular panel actually had a representative from ILPA on the panel. And I think, one of the things he said that made a lot of sense to me was there probably won't be NAV-based facility guidance in the first iteration of these quarterly reporting standards because it only impacts about 5 or 10% of the people. So just like Janice said, they're really being mindful. They don't want people to have to comply with 3 different standards. They also don't want to be creating new requirements that they really want to focus on leading with standardizing what the industry really is already doing, the best practices. So I thought it was a great panel. Nice summary, Janice. I guess that brings us to robust policies and procedures, which was a super well-articulated conversation around an area that the SEC said, hey, this is actually super important. So some of this information that came up here, and then a lot more context from our panelists, is from the risk alert, from the marketing rule, and the problems with policies and procedures being that they can't just regurgitate what the requirements are. You really need to include in there how you comply. Some templated policy documents include background requirements or context on what the requirement's asking for in addition to how a firm complies. And that can actually be really helpful. But what you don't want to do is not include how you as a firm actually comply. Another item that does come up during the verification a lot, you need to pay attention and detail in your policies who owns the responsibility for some of these procedures. And they brought up GIPS report, accessibility and distribution. Is the performance team responsible for making sure and tracking GIPS reports are distributed, or is that sales, or is it client relations? Let's get that in the policies. Who's actually tracking that? And then as far as GIPS reports accessibility, are you making those reports available to all, and then assigning responsibility for maintaining and monitoring to make sure they stay complete and accurate? Or are you limiting access and assuming more of a gatekeeper role so you can really track who they're getting delivered to? Decisions that every firm can make that make sense to them, but really good to have that detailed in your policies. Also, who do you pick for your GIPS oversight committee was a matter of discussion, and I love that they said, go for engagement of your team members over most tenured people. You want people who care about the standards and are also curious and trying to really connect what the requirements are and how the firm would best benefit from implementing those requirements and how. What needs to be reviewed and how frequently. Don't just rely on your third-party verifier coming in once a year. Definitely educate and engage your internal staff, and there'll be a lot of benefits from doing that and not having it fall all on one person in your compliance department or one person in your performance department. And they really recommend you tailoring your presentations so that executive staff might just be getting 1 or 2 slides, and then if it's for marketing and compliance, because this is really relevant for them, maybe it's 5 to 10 slides. And then obviously if it's somebody who is hands-on GIPS team folks, that's going to be a much bigger presentation. And I just like that they went to that level of let's just talk about details of what makes sense at our firm and what we offer to you, and definitely make this part of your new employee onboarding, that they get at least one of those overviews.
Kim, we have a Q&A. Is the GIPS Oversight Committee a requirement or a recommendation?
All right. It's not a requirement.
Yeah.
And that's up at the conference.
Yeah, and I think it depends on the size of your firm too, right? The smaller your firm, the more involved people generally are with the processes. The larger the firm, the more you have teams that are pushing things down and pushing things to other people. And so I think the size of your firm is going to matter quite a bit. So it really just depends on what's a best fit for the firm itself. And then, oh, go ahead.
No, I agree. And I think, one of the things we always tell people when they're getting into compliance, you want representation from all the different departments initially. And so it would just make sense to also have representation from portfolio management. They're going to have a lot about strategy and account assignment. And so it's good to have them as well as sales, marketing, compliance, performance. But it's not a requirement. It could be one person.
Right.
Yeah.
And then,
great question.
Kim, what about training? I mean, I know we do a lot of training for our clients, and we get brought in on occasion. And maybe I missed this, but what's the frequency, and is it best practice to bring in maybe your verifier to come in once a year and do training on GIPS, or asking an SEC consultant? What are your thoughts on that?
Yeah, I think, we have a GIPS for marketers presentation that we like to do, especially for firms new to the claim of GIPS compliance, how that's going to impact and change what they're doing. So yes, we're happy to do specific training at any level of detail, and depending on the size of the firm, maybe multiple trainings with different levels of detail, or if you're a 5 to 10 person firm, let's just get you all in there and have a conversation about it. But we're happy to do those for our clients as part of our services built in. and certainly can do training for non-clients as well. If you're looking to have an outside voice, they talked about that. You know, it is helpful sometimes to get another voice in there, gives it a little more weight to bring in a consultant.
Yeah, it was really interesting. Last week, I actually did a training for a firm that just came to us from another provider, and they've been claiming compliance for a long time. And they had the whole entire firm in that training session, including the owners. And it brought a lot of weight to the presentation and to the importance of what we were talking about. And especially when it comes to distribution, right? When we're talking about GIPS report accessibility and distribution, I think having the powers that be in that meeting shows that it's really important. And so not only bringing in a third party, but making sure that the right people are there can be really helpful to helping compliance manage their spectrum of risk. And that's really what it comes down to.
Right. So, and when they asked about frequency, you know, new employees was really the statement that was made. Do you have to do this every year? That would be overkill for the whole firm, I'm sure. But for sales and marketing, maybe you do. I mean, but for new employees, absolutely then, as part of onboarding. And the final item on this particular tip for robust PMP is the pros and cons of outsourcing came up as a discussion. And, you know, the panelists really felt like there was a huge benefit to having in-house expertise. So yes, if you want to maybe keep your performance team, but outsource technology, even maybe account membership and other areas of it, but make sure there's somebody at your firm with some GIPS expertise, and it's an opportunity for people at your firm, get the CIPM, raise their level of knowledge, become an expert, find a niche. I'm going to tell for the other discussion, primary discussion in this session was on verification.
Yeah, so the question becomes, where does verification come in? How does it support the firm? And I think verification supports the PMP and marketing materials, right? So verification has a lot of really great value. Obviously, we're a verifier, so we're going to say that, but it was really interesting to hear panelists talk about that, and people, so the panelists were very specific in this, were clients. They were people receiving verification, and they talked about how verifiers find things in the PMP that maybe you wouldn't normally find, because you go through, hopefully that annual review, and the review is looked at from a new lens every year. That's the hope. And through, what new rules have come out? What about the risk alerts? What about enforcement action? How do those apply today instead of maybe 2 years ago when the rule came out? So making sure that your verifier is doing an annual review to ensure, not ensure, but obviously make sure that your PMP is as up to date as possible. And then internally, we're hopefully a thought partner, and we help firms navigate the gray areas of the standards and the performance aspects of the SEC marketing rule. You can use us, like we said, for training. I thought it was interesting. One of the questions, there was a Q&A in one of the sessions about, should we include our verifier on our oversight committee, on our GIPS oversight committee? And the answer was overwhelmingly no. And the reason why was because the oversight committee is managing the firm's claim of compliance with the GIPS standards. That's the goal of the oversight committee. And what you don't want to do is create an issue with independence. And because verifiers need to be very independent, we can't make management decisions for firms. Including them on an oversight committee could be an instance of a breach of independence. Now, that doesn't mean that if you have questions that come up in the oversight committee, you can't consult your verifier and ask them their opinion. because you obviously want to be utilizing them in that way. But just some things for consideration. We agree that being on the oversight committee as a member is not best practice. It could be considered a breach of independence. We look across our clients and kind of look at what people are doing for best practices and trying to get that out to all of you and what are other firms doing. That's the benefit. That's a huge benefit of having a verifier is you sometimes don't know what your peers are doing, and that's a really great opportunity because we work with lots of clients. Also, if you have a verifier, looking at the post verification, what can you do to make this better? Where are some improvements? Sometimes in verification we find things, but we say this isn't material to the verification, but it's an area of improvement. Let's work together and figure out how you can do this better. And then there's been a lot of discussion lately, and Kim and I get to have this discussion pretty regularly with new clients. What's the benefit? Is there any benefit to performance examinations? And for those of you that maybe aren't familiar, performance examinations are for a specific GIPS report, and it's in addition to the GIPS firm-wide verification. And of the panelists that were there, one said yes, one said no. I think it's really specific to your firm and what makes sense for your marketing efforts. And if you want that, I think the performance examinations can be beneficial if you're having a hard time with internal controls around updating marketing materials and your GIPS reports. Most of our clients have gone to not receiving performance examinations, and I've heard that across the industry as well. And they're just doing the firm-wide verification. But again, I think it's a case-by-case basis, and you have to make the decision for your firm and what makes sense.
Excellent. And it was an excellent summary.
Yeah. And with that, Kim's going to talk about attribution and performance.
Yeah. Attribution and performance. These were deep dive sessions, an hour to 90 minutes long for the deep dive into performance, and we can't really do them justice here. The attribution session was fundamental, and they let us know right up front. First they had to talk about baseball analogies for what is attribution, but they were loyal to both Red Sox and Mets. They let us know it was going to be a fundamental. Let's define attribution. Let's define contribution. Let's think about what are the important input decisions so that you can make sure your results are meaningful. And really talking about what's common in the industry, how many people are using transaction-based, how many people are using holdings, how many use a little bit of both. And it was about a third, actually, on that one. A third used holdings, a third transaction-based, and a third used in both of them at different times. And so just getting some context around what's the industry doing and really understanding this. And the important input decisions are selecting the appropriate model. I think the Brinson 11 sectors, very common for equity, but not for fixed income. You have to think about what's driving returns for fixed income and customize for currency returns, really looking at interest rate differentials, things like that. So good session, solid session, and really encourage people to add more detail to your policies and procedures around what you're doing so that you can be consistent in your attribution over time. Just like your performance. Now, they did ask the questions on this session, are people showing attribution net? And this also came up in the performance discussion as well, which I will now move to, the performance deep dive. And the answer was about 50% of firms are pretty much, whether it's attribution or yield or some other characteristics, pretty much 50% of them, attribution, contribution, and yield, are not showing them net of fees. So that was some context that we got from these deep dive sessions that are they really were excellent. And for the folks that might be on this call whose job it is to calculate performance, especially if you're working with a private fund manager who you're doing it in Excel. This session was excellent. And the models, very much like the resources available on the GIPS Standards website, where they have the actual performance calculations and the formulas are available. They really laid out some very difficult performance calculations, not just on IRR, but going into different types of fees, and really capturing hurdle rates and watermarks and clawbacks and carried interest allocations, deal level net returns, and really talking about and showing, how to address the best way to capture a deal level net return, which there's a lot of discussion around that. There's a lot of answers in this session, 90 minutes. I would encourage you that if this is relevant for you, buy the digital package. The CFA Institute is offering for $449. Folks can buy the package and they can have access to all the videos and all the slides. And this would be, I think, the most heavy and really practical session that if you just had time to take that in, if this is important for you. We don't have 90 minutes to go into all of the formulas and calculations, but it was an excellent session. And with that, Janice, what's next?
So there was an overarching interest in AI at this conference. Lots of discussion. I think it's being talked about a lot in the industry. And how are we using AI in investment management? Is it going to take over our jobs? That was a question. Are we all going to be out of work? And right now the answer is no. I think there's still a people element that's going to be necessary. Max gave a whole session on AI and what does this look like in investment management? And he was talking about how it looks a lot like the Industrial Revolution, more than the internet in the 1990s. It's advancing quickly. So this isn't something that, is going to take years. This is something that is getting smarter and smarter every day. And so the analogy he used was going from like a mediocre intern to a very good analyst in a few months. But garbage in, garbage out is the other piece that he was discussing. And the fact that our AI is only going to be, whatever AI you're using, is only going to be as smart as your inputs that you're putting in. And so there are some firms, some consultants that are starting to use this, and we're seeing this come out in different ways on the performance side and then also on the marketing material review side. So I think it's here and it's here to stay, and it really depends on firms and spectrum of risk and how much you want to use them. One of the other things I found really interesting was that he talked about how his firm is no longer really, when they look at hiring, they want them to have some sort of data science background or have a degree. Also, CFA Institute's data science certificate was brought up. And so looking at ways to elevate your skills, I think when it comes to AI is really important. And then when we talk about the use of AI in marketing presentations, I was part of a session on marketing material reviews, and there was a woman who she helped create an AI to review marketing materials for a very large firm. The thing is about where we're at right now is we need guardrails, and they compared it similarly to when cars were first invented. They didn't have seatbelts, but now we have seatbelts and speed limits. And so I think this is going to be an instance where it's harder to keep up with putting in guardrails than the pace at which things are happening. And also just looking at, again, who can you hire to help bring on and bring in implementing AI in the firm and how to do that. We also talked about, why care about marketing material reviews, and what is the big deal around making sure that you have a process. And we know this, but again, it's about putting it out there and saying, it matters. Your first impression from your clients matters. How can you make a good impression? And then just thinking about engaging your team and how are they putting the firm out to the marketplace? Is it through podcasts, YouTube, website, TikTok even? That's happening. And we've seen a lot of firms get written up for off-channel communications. And so making sure that your policies are encompassing the vast majority of communication channels. And just, considering your audience for appropriateness of the marketing material that's being presented. So those are a lot of the things that we talked about when it comes to the use of AI and then use of AI in marketing materials and presentation best practices. And with that, go ahead,
well,
Kim.
There was a lot of positive buzz around that too,
Yeah.
in terms of what can be done and how much it can ingest the GIPS standards and FINRA and SEC, and then really look for requirements. So exciting and also a challenge to keep up. And I loved that, I think of marketing reviews as happening after the fact. They've got the nice deck and the compliance person is going through. And then they brought up, but with videos, you don't want to do that, because by the time you go and create a video, you don't want to, after the fact, have your compliance person going, oh, no, you can't say that. So, I mean, it really is changing. It's absolutely changing. So, yeah, great summary of just AI in lots of sessions this year.
Yeah, and we have about 1 minute left here. So if anybody has any questions, please don't let us leave without answering those. And then we can talk about the Help Desk Live.
Yeah. I wasn't going to do anything but just reference that there's a lot of composite construction and maintenance questions that are there every year. There was quite a few questions that came up that have flexible answers, like, do we all have to use a calendar year on our GIPS reports? No, you could actually do a fiscal year, just be consistent. What about standard deviation calculations? Populations or samples? And it doesn't matter, either one's okay. Document it in your policies. CFA Institute does prefer populations, so that's just, but it wouldn't require, if you changed it from one portfolio accounting system to another, you don't have to document you're changing your methods. It's just good to have that noted in your policy. Same thing with AUM. Yes, we want fair value, but if the best you have is NAV for funds for your marketing material assets, use a NAV for funds. That's fine. And it would be a nightmare to try to not use your NAV for funds. So, Janice, why don't you take the last 3 bullet points and close us out?
Yeah, so making sure that your names of GIPS reports are consistent. And I think the biggest takeaway here was you don't have to use the terminology GIPS report or composite. There is a place in the GIPS standards that are prescriptive, and that's around carve-outs and making sure that you use the terminology carve-out in your composite title. But that's really the only place that's prescriptive. And then when we talk about, the specific compliant requirements and, making sure that you're referencing GIPS reports in your compliance statement and at the top in the agenda of your pitch book, making sure that those are referenced towards the end. And any fund fee disclosures, making sure that those are specific to the fund and not a range. So if you're presenting, let's say you have multiple classes, you would want to show the highest class and the expense ratio for that. We do have a question, and that is, are you able to provide additional guidance or point us in the right direction to review best practices and industry standards around policies and procedures? And I think we have a couple of articles on that we can share, and we can do some more. On the GIPS Standards website, there is a policies and procedures document sample. It doesn't cover everything, but it covers a lot. So there's that. And then I would say, if you're working with us, we're also happy to answer any questions specific to your situation. And if you're not working with us, we're still happy to answer those. Any other things to add, Kim?
No, that's great.
Okay. Thank you all. And we will be sending out slides and the recording early next week. Have a great weekend and a great day.
Thanks. Bye.